All right, well, why don't we go ahead and get started while everybody's getting settled. So welcome to the 94th International Atlantic Economic Conference and welcome to Washington, D.C. It's so nice to see everyone in person rather than via Zoom. So this is just, this is wonderful. I also want to extend a welcome to our first-time attendees. I hope you enjoy the meeting. So just a little bit of background. The purpose of the organization originally was to increase communication across the Atlantic. And so the conference provides a forum for open scientific discussion of topics from all interest areas within economics and finance. And so, often it's worthwhile sitting in on a session where you really know nothing about the topic because you always, come away with something new. So the highlights of the meeting this year are first our presidential address, which will be starting shortly on institutional investors and asset prices. There's a plenary panel tomorrow, and the title of that is Flexible Exchange Rates, Capital Mobility, and Monetary Instability. And then tomorrow afternoon, we have the Best Undergraduate Paper Award Competition. It's always very exciting. We never know who will be the winner, but these will be the 4 finalists, so we'll be presenting. So anyway, I encourage you to attend. It's always very exciting to see who wins. I'd like to thank everybody who helped to make this conference a success. If you look in your programs on page 6, you'll see the names of all the people who organized sessions and contributed to the conference. In particular, I'd like to thank Nina Bodida, Jim Chen, who's seated here, Hussein Kasimi, Pierre Rafi, Maria del Carmen Ramos Herrera, David Suarez Cuesta, and Gilfi Zoega. Anyway, thank you to all. And during the conference, you can recognize them because they have a special ribbon on their name tag. So feel free to introduce yourself and say thanks or ask how to get involved in next year in some of their efforts to organize sessions. On the back cover of the program, you'll see an advertisement for our next meeting in Europe. And as I know, it doesn't say which city yet. We're still working on that. There's a lot going on in Europe. So anyway, stay tuned, but the dates are at least chosen. So March 23rd through 26th. And then for that meeting, the abstract submission website is not open yet, but it'll open once we get back. So at any rate, I just encourage you to submit early rather than wait till it's late, because if you submit late, then there's obviously higher costs, and you don't want higher costs. In our October meeting next year, we have not yet chosen the location, but most likely it will be Boston, October 5th through the 8th. So anyway, the officers and I wish to thank you for being here and hope you have a great experience. If you need anything, please feel free to either contact me or one of the 2 people at the desk, Joshua or Laverne. They'll both be very happy to help you. So without further ado, I'm going to introduce our head table. So to my immediate right is James Chen. He's a professor at Michigan State University. He's a current member of the Society's Executive Committee and a member of the Board of International Advances in Economic Research. Seated next to him is Siba Brada Das. He's senior researcher at the International Monetary Fund, and he's also a current member of the Society's Executive Committee. And then seated next to him is Fazli Sadiq. He's a professor at the University of New Brunswick in Canada, and he's also a current member of the Society's Executive Committee meeting. So now I will introduce our speaker. So our speaker today is Dimitri Vayanos. He's a professor at the London School of Economics. He's a director of the Financial Markets Group and the Paul Woolley Center for the Study of Capital Market Dysfunctionality. He's a fellow of the British Academy, as well as a director of the Review of Economic Studies. He's a SEPR Fellow, Research Fellow, and an NBER Research Fellow. So without further ado, I turn it over to Dimitri. Dimitri, are you ready to share your slides?
Yes. All
right. Well, I'm going to go to the back, and if anybody has questions along the way while he's talking, feel free to interrupt, and I'll have the microphone, and I'll just bring the microphone to you. Just raise your hand.
Okay, thank you very much, Kathy. So are my slides visible to everyone? Okay.
Yes.
Okay, perfect. Thank you. All right. So first of all, thank you, Kathy, for the introduction. And I thank the Society for electing me president. I apologize for not being with you in person today. A kind of COVID issues made my travel difficult. So The subject of my address is the growing institutionalization of financial markets and the effect that this has on asset prices and the real economy. So let me give you some data that kind of shows these significant trends. So on the left-hand side chart shows the assets held by insurance companies, pension funds, mutual funds, and other funds such as exchange traded funds, closed-end funds, and others in the US over the past 80, 90 years. So, 70, 80 years. So it shows that the assets as a percent of GDP have grown tremendously, assets held by these institutions. They have grown about fourfold. The same kind of growth has been experienced in the UK. This is in the chart in the right. But actually only over the over a shorter period of time, over the past 40 or so years. So this information is reported in a speech by Andy Haldane, the former chief economist of the Bank of England. Now, the growth, so essentially there is a lot of growth in the role of these institutions, the insurance companies, pension funds, mutual funds, etc., in financial markets. Now, this growth reflects partially the growth in wealth to GDP in the economy, which roughly doubled in both in the US and in the UK since the 50s. So from about 200 to 300% to about 400 to 600%. However, it is not just, does not reflect merely the increase in wealth to GDP, essentially more savings by households, but it also reflects the fact that there has been a shift in the way wealth is being managed. So, for example, Kenneth French reported in his presidential address to the American Finance Association that in 2008, that while individuals, households were holding directly about half of the US stock market in 1980, they were holding about 1/5 of the stock market in 2007. And of course, the trend has been continuing in that way. They're holding even less now. The remainder is primarily held by these institutional investors that I'm showing you in my charts here. Now, the growth in institutional holdings, as the charts show, pertains to all types of institutions, not only insurance companies and pension funds who employ asset managers who essentially manage kind of this institutional money, they work for the institutional sector, but also to mutual funds who are asset managers themselves and invest primarily for the retail sector, for the individuals. Okay, so that's one thing, one kind of important trend, this huge growth in this institutionalization of asset markets and the growth in institutional holdings. The other important set of trends has to do with the composition of these assets. So there have been kind of essentially two kind of changes in these different parts of the spectrum. So first of all, there has been a huge growth over the past 20 years or so of specialist mutual funds, such as, for example, hedge funds or private equity funds, and also mutual funds investing in specialist markets, such as emerging markets, high-yield bonds. For example, over the past 20 years or so, their assets have grown much faster than assets under management by the kind of in the whole industry, kind of institutional assets in general. And the other trend on the opposite side of the spectrum is that passive investing has also grown hugely. So essentially investing in investment by, let's say, index funds, exchange traded funds that are just holding market indices, such as for example, the Standard & Poor's 500 index. Here, if we plot the chart on the right, the assets held by this set of funds, index mutual funds and index exchange traded funds, as a fraction of total assets held by all funds, active and passive. This was about 3% in 93. Kind of passive was a very small corner of the market, and now passive has overtaken active since 2020. Okay, so the flip side of these trends is that the share of active funds has gone down. So in traditional markets. So for example, large cap equities or government bonds. So these are becoming less and less kind of important. Okay. Now, these trends raise a number of questions. So about asset prices. Are asset prices becoming more efficient as a result of the growing institutionalization of asset markets? Are they becoming less volatile? A related question to that has to do with systemic risk. Is the fact that more and more assets are held by these institutions, kind of there is this level of delegation that enters. Does it create systemic risk? Does it create more volatility? And I will come back to that later. The other big question is, are firms better able to finance their investments? Is the cost of capital declining for firms as a result of this institutionalization of markets? Okay, so this is about kind of, let's say, the positive side, as opposed to the normative side. And on the normative side, we can ask the question, what are the implications for regulation and policy? Let's take it as a given that there is more more and more institutional presence in markets, and this trend is going to continue, is likely to continue. How should regulators do anything to make markets work better given this trend? Is there scope to improve market outcomes? Okay, so in my talk, I will provide some answers to these questions based on research that I have been doing. And okay, so this is certainly will not be the definitive answers. This is a growing research area, and especially research is needed on the second part of the question, kind of on the normative side. But anyway, so I will show you kind of various answers to the first set of questions and suggesting some implications on the normative side. Okay, so now to think about this, to understand the implications of this growth of delegated asset management, it's important to always keep in mind that there is an agency problem, that the asset managers are agents investing others' funds. This agency problem manifests itself in different ways, but kind of an important, useful way to think about it is that investors are uncertain about the ability of the managers running these funds. So they think that maybe they're not sure whether their managers are good or whether their managers, maybe they were good in the past, but now they are no longer able to understand the way markets are operating. So for these reasons, investors evaluate managers' performance relative to benchmark indices, or maybe sometimes relative to other funds. And also they may want to constrain managers' deviations from indices, how far the portfolios that managers are holding deviate from these benchmark indices. They may want to even impose explicit contractual constraints. On the other side, managers themselves kind of understand that investors make inferences about their abilities, and they may choose their portfolio strategically to account for that. For example, they may want not to stray far from benchmark indices to minimize the risk that they may underperform those indices. They may window dress their portfolios to look better than what they are. Now, there are two layers of agency here. So one layer is that asset managers, I mean, in the case, for example, of pension funds or assets held by insurance companies or by sovereign wealth funds, they are agents of the fund trustees. For example, pension funds have trustees who appoint the asset managers. At the same time, the trustees themselves are not themselves the owner of the wealth that's being managed, but are agents of the ultimate asset owners. So the workers whose pensions are being, whose savings are being invested, of the taxpayers, for the case of sovereign wealth funds. So agency problems can be quite complicated, and then they can create distortions. So here's the roadmap for the rest of the talk. First of all, I will show how these agency problems give rise to what I refer to as procyclical trading. So essentially to buy assets that rise in price or sell assets that drop in price. This can happen, this procyclical trading, because investors kind of chase performance by asset managers. They tend to go to winning managers because of this learning about managers' ability. or asset managers themselves may want to keep deviations from the index in check. And for this reason, again, as I will explain later, they engage in this procyclical trading. And this procyclical trading can have implications for excess volatility, for misvaluation in markets, and potentially even for systemic risk. Then I will talk about passive investing, where one would expect that these agency problems are not present, because after all, passive funds are just mechanically holding indices, market indices. They're not really supposed to be trading. And I will show that, in fact, that contrary to this simple logic, passive investing is not neutral. So in fact, passive investing raises disproportionately the stock prices of large firms or of overvalued firms if there is some mispricing in the market. So passive investing somehow tends to bias the way the economy works in favor of larger firms, and also causes kind of the aggregate stock market as well to go up, causes some kind of overvaluation bias. So I will talk about these mechanisms. I will show you that some of these mechanisms connect to each other, the ones that are on these active funds and the ones for the passive funds. And then I will summarize and draw some policy implications. All right, by the way, Kathy said that, but let me also say myself, so that if you have questions, please feel free to interrupt me. So Kathy has a mic, and you can just call her for your questions. And please there's no need to wait until I finish all my talk to ask me any questions. And sometimes it can be useful to ask questions during the talk, that is kind of especially clarifying questions that can be very helpful. Okay, so, all right, so let's go to procyclical trading. Now, there are two sources for procyclicality. As I already kind of allude to here, there are these two bullet points. One is kind of what I call flow-based procyclicality. So let's assume that investors move from underperforming to overperforming funds. Why might they want to do that? Because they make inferences about the abilities of the managers running these funds. They think that overperforming funds, they were not just lucky, they were just run by better managers, and vice versa. What happens if investors behave in that way, which may be rational or may be irrational? So there would be amplification of market movements. For example, price drops of underperforming assets are going to be amplified. If an asset has some negative shocks to its fundamentals, let's say the earnings of the company, then the investors are going to sell mutual funds, kind of move out of funds that are holding this asset, that are kind of holding a large amount of that stock. And these funds are going to sell these assets to meet these withdrawals. This will cause a price drop for these underperforming assets. And the price of these assets, because of this selling pressure, could drop below assets' fundamental value, kind of causing excess volatility in the market. So this is a graph that comes from a paper by Koval and Stafford that is called Asset Fire Sales and Purchases. So that essentially it shows the price behavior of a typical stock held by mutual funds that experience what they call extreme outflows. They look at the 10% of funds, of equity mutual funds in the US, that in a given quarter that experience the worst outflows. And then they look at the stocks that are being sold, and they trace the price behavior of these stocks before that quarter, the event, what I call here the event quarter here, and after. So the typical stock that is held by these kind of under funds that experience these extreme outflows has done very poorly over the past year. And this is not a surprise, because this is how these funds became kind of underperforming, because their average stock has done poorly, is that these stocks perform even worse kind of during the quarter of the extreme flows. And this is just because of the selling pressure caused by flows. The particularly interesting bit is that there is a recovery, a predictable recovery, over the next year and a half after these outflows. So essentially this speaks to my last bullet point here, is that prices drop below assets' fundamental values. This is why there is a predictable price rise. In other words, prices go to a level that is below what is the kind of true fundamental value of these companies. And the price rise is significant. It's about 10%. I mean, the return during this recovery phase is about 10% return, 10% predictable return. Of course, there is some risk involved, but still 10% return is quite high. Okay, so now, as I said, this flow-based procyclicality could arise because of the fact that flows can be chasing performance. Now, this can speak, as I kind of alluded a little bit in my previous slide, to a kind of important kind of puzzles in financial markets. So these puzzles in finance, we call them anomalies. And perhaps the two most prominent financial market anomalies are momentum and value. Momentum means the documented assets who have performed, let's say, poorly over the past year, past 6 months, to predictably perform poorly in the near future. This is called momentum, and this has been documented and is a big violation of market efficiency, of the efficient market hypothesis. The other kind of significant violation of the efficient market hypothesis is value, which says that essentially it's a bit like the opposite of momentum, but it's not quite the opposite. It's a kind of, there is some difference in the way the predictability is viewed. So value is that assets that are cheap relative to measures of fundamental value tend to subsequently do very well. So now the two kind of look a little bit like they are the opposite, because assets that are cheap relative to fundamental value, assets that have performed poorly in the past. So, but momentum concerns poor performance over the recent past, while value essentially says that assets that have become cheap because they have underperformed over a very long time in the past tend to subsequently overperform. So essentially what do we learn here? We learn that kind of bad performance over a recent period, let's say over the past year, generally tends to predict a continuation of this bad performance, kind of predictably negative returns. But bad performance that is over a more sustained period, like let's say 2 years, 3 years, 5 years, predicts the opposite, predicts a reversal, predicts a high return. So this have been big puzzles in finance, but can be explained, can be rationalized given the framework that I have introduced. And there is work on that, both the empirical work and theoretical work, to which I have also contributed, that essentially speaks to this phenomena. So following the story that I was telling you in the previous slide, if let's say there is a negative shock that hits the fundamental value of some assets, then mutual funds holding these assets experience low returns. These are the fire sales in my previous graph. Why do they experience low returns? They experience outflows. These are the fire sales. They experience these outflows because investors kind of move away from these funds, learning that because they infer that their managers have low ability, and the funds have to sell assets they own in response to these outflows, which amplifies the shock. So assuming these outflows are gradual, this is the momentum. This kind of causes this poor performance to continue because these assets are gradually being sold, and then the value effect is just because eventually, after all this selling, prices become so cheap that eventually they are predicted to rise. So, bottom line, this flow-based procyclicality can explain some important puzzles in finance, which makes financial economists excited because we kind of want to understand better kind of the way to predict financial returns. But it's also important in general, kind of even from a real economy viewpoint, because, for example, there can be very excess volatility in markets. There can be, in some cases, systemic risk. So, for example, there have been significant concerns that these flows chasing performance can create big swings in the bond yields for emerging market economies. So, for example, if bond prices for emerging market economies go down, then investors are going to pull out of emerging market funds, and it will cause bond prices to go down even more. So causing kind of big financing problems for emerging market economies. And so there has been kind of quite a bit of discussion about how to limit these mechanisms. A week ago, there were, many of you may have heard, there was important kind of procyclical behavior in the UK in the pension fund sector, that as the government made some announcements about its budget, kind of interest rates went up, and this triggered a lot of selling of UK government bonds by pension funds. So kind of not exactly the same mechanism, but related. So anyway, so these procyclicalities are important concerns. Let me now talk about the second mechanism that can generate procyclicalities, which is based on the constraints that the managers have. So this works as follows. Suppose that asset managers, for some reason, they have to keep their deviations from benchmark indices in check. Now, this can be the result of either contractual constraints. Investors may impose limits on how much managers can deviate from index portfolios because they are unsure about how good the managers are, and they don't want to take the risk that their managers kind of do crazy things. Or it can be the result of managers' own kind of incentive to minimize their career risk, not to have some risk of performing poorly relative to the benchmark, and investors kind of making negative inferences about them. Now, this causes procyclicalities, but in some kind of somewhat different way than what I was describing before. So let me take an example. Let's say that there is an asset that managers view as being overvalued. Let's say this asset, let's say think of it as an industry sector, for example. So this asset, let's say, has a 10% weight in the index, in the benchmark, and some managers give it 5% weight. And let's say for some reason that this asset keeps going up, rises to 20% weight in the index, then the weight, and I forgot to say, and let's say that managers kind of give it a 5% weight because they would like to give an even lower weight, but there is some constraint limiting how much they can underweight. Let's say they have to stick to a 5, the difference in weight has to be at most 5%. So they cannot deviate, they cannot have a weight that is different from the index weight by, let's say, 5%. So if the asset has 10% weight, they want to minimize their weight, so they have to stick to 5%. So the asset goes to 20, the manager's portfolio weight is going to go mechanically to about 10%, but to stick to this constraint, this 5% difference, managers have to buy the asset to raise the weight to 15%. So this gives rise to procyclical buying of these underweighted assets, which can be, let's say, overvalued assets. Now, of course, there will be the flip side of that. There will be some managers who are overweighting this asset, and if the asset goes up, the deviation from the benchmark is also going to go up. Now, however, this effect, and this is going to generate counter-cyclical trading, because now they have to keep the deviation from the benchmark in check, they have to sell the asset. However, this effect is going to be weaker, because when managers perform well, investors will not be as insistent that these constraints are met. A manager who overweights an asset that rises in price is going to look pretty good to investors. So investors would say, okay, fine, we have given you this constraint, but we're not too worried now about your ability. While for a manager that was underweighting this asset and the asset went up, investors are going to insist very much that the constraint is maintained. Okay, so bottom line, there is this procyclical trading of these assets that rise. And moreover, the other kind of aspect is that these constraints are going to be more binding for overvalued assets. Why? Because they account for a larger fraction of market movements than undervalued assets. Let's say if an asset has let's say 10% weight in the index, let's say an overvalued asset, these constraints are going to matter more than for an asset that has, let's say, 2% weight in the index. This difference, this constraint that to keep the deviation from the benchmark in check. So constraints are going to be more binding for overvalued assets, which means that this procyclical trading that I just described is going to be associated primarily with overvalued assets. And therefore, what we see here from this logic is this link between overvaluation and high volatility. So now in finance, we like to think about risk and return being positively related, high risk, high return. But here is kind of essentially the opposite. If there is, let's say there is some mispricing in the market, that there are some assets that are overvalued, it can be the case that these assets have high volatility. So somehow this risk-return relationship can be inverted. And there is some evidence for that empirically. The other implication is that of constraints being more binding for overvalued assets is that in the aggregate, the aggregate market is going to be overvalued because the investors will have an easier time kind of trading against undervaluation than trading against overvaluation, because constraints are going to matter more for overvaluation. So let's keep these two themes, these themes in mind. Kind of there is this procyclical trading, this inversion of risk and return, and this bias towards overvaluation for the aggregate market. And that, because I will come back to them when I talk about passive investing. So anyways, and again, this is builds what I'm describing you here is work that I have done with Andrea Buffa and Paul Woolley in a paper that is going to come out in the JP this December. Now, and
Dimitri,
okay, yes,
we have a question.
Of course.
Yes, thank you, Professor Vayanos. Pierre Raffi from UAM in Munich. What you're describing to me really reminds me very strongly of how behavioral finance is approaching such issues with regards to risk aversion, loss aversion, which also accounts for the preference for, let's say, ETFs, which is kind of avoiding risk of not being as good as the market for private investors, and here for asset managers as well. Is this the direction where you're going, or is this in your consideration? Because that would seem to me one approach where you could find explanations for such behaviors. Thank you.
Thanks for the question. So, okay, so here, in some sense, it's a bit of a, you may view this as a parallel kind of a track. Okay, now, kind of, and there, there are connections as well. So here, the manager's concerns about underperforming benchmarks is not in what I'm describing here is not a behavioral kind of feature. It's just that it's a rational reaction to the fact that investors may be learning about managers' ability, that investors are uncertain about managers' ability and are learning about it. So there's nothing behavioral about that. Asset managers just are concerned about their reputation, and for perfectly rational reasons, because if they do poorly, investors are going to, the pension funds who are employing them, they're going to fire them and go to hire another manager. Okay, so now, however, there may be some behavioral interpretations of some things that I described. For example, when I was talking about investors chasing performance, kind of this flow-based procyclicality, there is, as I said, there can be a behavioral element. It can be that investors maybe do excessive extrapolation when they move from losing funds to winner funds. Investors may not account for the fact that some of this poor performance may be due to lack. They kind of may attribute this to ability. So there is where somehow I'm happy to be kind of more eclectic and say that there may be some behavioral element. But the way what I described here about how managers behave, this I view it kind of more like a rational kind of response of managers to what investors can do. Okay, so anyway, so these are the coming back okay, so I showed you some kind of mechanisms that cause procyclicality due to this kind of agency relationship inherent in asset management, and that this procyclicality can cause these asset pricing effects. Now, let me skip this graph and let me go talk a bit now about passive investing, where I will show you, in fact, some parallel mechanisms. Now, passive investing, in principle, should not be prone to procyclical trading. So why is that? Here, there is no role for managerial ability, or at least there is a minimal role for managerial ability, because managers are, passive funds are holding indices. So they are not selecting stocks. They're just doing something very mechanical. So in principle, there should not be any performance chasing flows, which cause procyclicality. Also, there is not any issue about constraint-induced procyclicality, because funds are holding exactly the benchmarks. So it's not a matter of these deviations from benchmarks becoming smaller or larger depending how the market moves. Essentially, these deviations are always zero, or essentially negligible, very close to zero. However, passive investing can generate other distortions. Okay, so some of them have been emphasized in the literature already, kind of many years ago. So, for example, the famous Grossman-Stiglitz paper has talked about stock prices becoming less informative when there are fewer informed traders relative to the uninformed. And we can think of, in some senses, the active managers more being like the informed traders, while passives are kind of mechanically holding the market portfolio. I mean, holding some market index. Now, another kind of distortion emphasized in the literature is this what's called the index effect. Coming back to some papers by Harrison, Gurel, and Schleifer, and the huge subsequent literature, that the prices of index firms, of firms that are in the index, rise relative to non-index firms. For example, when a firm is added to the index, its price goes up mechanically because there is now a new clientele for this firm stock, which are all the passive funds that are holding the index. And here I will talk about some work that I'm doing kind of currently that is but a very different effect, which is that there is a bias, kind of the rise of passive investing kind of causes a bias that favors the largest firms in the economy, that the price of the largest firms rise the most, even when the index includes all firms. So this is not an index effect. Okay, so to explain, let me first of all explain to you why it is somewhat surprising that the price of the largest firms in the economy should rise the most as a result of the growth of passive investing. Why is surprising given in light of basic finance theory? So let's take a simple CAPM world. So let's say that the passive flows are due to entry by new investors in the stock market. So in the CAPM world, what this means is the entry by new investors means that the market risk premium drops. Essentially, the compensation that the investors require for holding the market, the index, for holding the market, for holding the US stock market. So when the market risk premium drops, stock prices are going to rise, and they're going to rise especially for firms that have high CAPM beta, so essentially high sensitivity to market movements. This is CAPM beta. Now, empirically, it's well documented that, going back to the work of Fama and French, that the small firms have higher CAPM beta than large firms. They are kind of essentially small firms are more sensitive to market movements for various reasons. So therefore, growth of passive investing should imply that small firms benefit most, they realize higher returns than large firms. But in fact, we find that the opposite is the case. And we show this theoretically, and I will also show you some empirical evidence that this is the case. So here is the intuition why large firms rise the most. So first of all, in response to passive investing, to a growth of passive investing, as I described in my previous slide, stock prices are going to rise. Now, when stock prices rise, also price movements are going to become larger in absolute terms. Price movements becoming larger means that there is kind of more risk by investors kind of investing in the stock market. And this increase in risk can attenuate the increase in the prices. Because, okay, so there is more demand by these passive investors, but at the same time, price movements have become larger. Now, let's see now how do these effects manifest themselves for different size firms. For small and medium-sized firms, the only price risk is systematic risk. Essentially, is the risk that kind of is economy-wide risk, because these firms are small relative to the economy, to the size of the economy, and therefore they are firm-specific risk. Their idiosyncratic risk is not really priced at all. So now, the increase in risk concerns their systematic risk, and therefore the attenuation effect is going to be strong because systematic price movements pertain to the investor's entire portfolio. So when kind of the systematic risk increases, there is a strong attenuation effect. Now, for large firms, things are a bit different now because the firm-specific risk of those firms, the idiosyncratic risk of those firms, is to some extent priced, maybe with a smaller premium than the systematic risk, but these firms account for a non-negligible fraction of aggregate stock market movements. I mean, Amazon accounts for about 1/20th or so of the US stock market. So even though it is still 1/20th, it's non-negligible. So, this comes back to a significant literature in macroeconomics about granular effects that says that the aggregate fluctuations can also be to some extent driven by what happens to large firms in the economy. So the idiosyncratic risk of large firms is priced, and the fact that this risk now becomes bigger is not as big of a deal as for systematic risk, because idiosyncratic price movements pertain only to investors' position in only one firm. It is still can be Amazon, which is a big firm, but is less much less than being the entire portfolio of investors. So essentially, idiosyncratic risk of large firms and systematic risk are repriced differently in response to these flows. Okay, so now let's keep this logic in mind, and I will show you that this mechanism will imply not only that the flows into passive funds cause the prices of larger firms in the economy to rise the most, but also can cause a number of other phenomena, which I will show you for a number of them empirical evidence. So passive flows are going to raise not only the stock prices of large firms the most, but also their stock return volatility, are going to make them more volatile as well. So, which kind of sounds a little bit at odds with kind of standard theory, says that if volatility rises the most, their prices will rise the least. So it's again, it's a bit of an inversion between risk and return. So what's the intuition? The intuition is that as I described in the previous slide, the risk premium for large firms' idiosyncratic risk is going to decline. Therefore, idiosyncratic price movements become larger for large firms, and this can cause kind of more volatility. The other result is that the effects of passive flows are going to be more pronounced for overvalued firms. So not only for the largest firms in the index, but also for the overvalued firms among the index's largest. And here the logic is a bit different, is that the attenuation that I described in the previous slide is going to turn into amplification. We'll have a kind of an amplification effect. So what is going on? So these larger idiosyncratic price movements that happen for large firms are going to induce investors who hold short positions in overvalued firms, because these investors kind of short these overvalued firms, to scale them down, the short positions. This will push up the price of these firms and cause these idiosyncratic price movements to become even larger, causing investors to become even more wary about holding short positions. So this can be a story, for example, for Tesla. I don't know, so there has been all this discussion about Tesla and that it has this fan club of investors who are holding it. So so a number of investors who were holding Tesla, or some asset managers who are underweighting Tesla relative to their benchmarks. So when Tesla becomes bigger and bigger, and means that there is more and more risk of being short Tesla, investors become less and less willing to hold it, and this causes Tesla to become even bigger and even more volatile. The next result is that passive flows are going to drive the aggregate stock market up, even when they are entirely due to a switch from active to passive, not even to an entry by new investors into the stock market. Even there is just a pure kind of switch within the current set of investors in the stock market, there will be an overvaluation bias in the market. And this I will show you kind of that if there is this switch from active to passive, small firms are going to lose, undervalued firms are going to lose, because active funds are invested more in the undervalued firms. But the wins for the large firms or the overvalued firms are going to be far larger. So there is this overvaluation bias, a bit similar as a similar theme to the one that I described earlier in the context of active funds. And finally, the index addition effects that the index effects literature has derived are larger for these larger firms or overvalued firms. I will show you the index addition effect for Tesla towards the end of my talk. Okay, so now, so I want to show you just that I have been talking so far without any math. So I want to show you a little bit of the model, at least so that you can see that behind all these intuitions that I'm describing, there is also some modeling. So, and then I will come back to some of the results and the mechanisms. So here is the financial market model that is going to generate the results that I just described. So it's a continuous, the analysis set in continuous time. There is a riskless rate, this R, which I would take as exogenous. And then there are N firms. And we assume that the stock of each firm has a dividend flow, which is made out of a systematic component, this Bn times DTS, where DTS is a systematic factor, and Bn is a sensitivity of the dividend to that factor. And D and TI is the idiosyncratic component of the dividend. And this D bar N is a constant component. So essentially, this is a parameterization that says that firms have some systematic risk, but also have some idiosyncratic kind of firm-specific risk. Okay, now firms can be large or small. This is controlled by how many shares they are issuing. Kind of large firms are going to have more shares issued. And this systematic factor and the idiosyncratic factor are going to have some, are going to evolve randomly over time, independently also as well over time. And we're assuming they follow this, what is called, what we call square root processes. Kind of these are essentially like AR1 process, autoregressive, but the diffusion term, I mean, the variance term is increasing in the level of the variable. So in other words, the changes in the dividend level are more the volatility of the dividend level increases with the dividend level itself. Okay, when dividends are higher, they also become more volatile in absolute terms, which is kind of something very plausible and realistic. Okay, so now, okay, this is the model. And okay, let me talk a bit about the agents. So there are three sets of agents. There are some people who I would call experts. So these people invest in all firms without any constraints. And then I give them this simple mean variance preferences. They care about the expected wealth that they have after a short period of time. And they care about the variance of their wealth. And there are in some measure mu1. And there are some what I call non-experts. And these people, I assume that they only invest in the riskless asset and only in an index, a capitalization weighted index that may include some firms, but not others. Perhaps it can include all firms. They have similar objective. So in much of what I will show you, there are only these two sets of investors. But in some of what I will show you, I will assume also that there are some noise traders who demand some shares of each firm inelastically for some random reasons. So this you can view this as a kind of irrational holdings. Now, noise traders are going to generate some mispricing in the market. This is why I will introduce them. But for the main results, this mispricing is not essential. But having noise traders is going to generate some additional results. Okay, now one can solve for the equilibrium in the prices in this market, and show that the prices are made out of three components. The price of, let's say, the stock price of a firm, a component that corresponds, that is the present value of this constant flow of dividends, a component that is the present value of the systematic dividends, and a component that is the present value of the idiosyncratic cash flows dividends. So, and now the important property to keep in mind for the future is that the price depends on supply. And it depends on kind of two measures of supply. Is essentially systematic supply is how much total systematic risk has to be held by agents, and also for each firm, the price of each stock depends also on the idiosyncratic supply, how much of the supply of that particular stock is thrown into the market and has to be held by these expert agents, who are the ones who are kind of determining the price of all assets in the margin. Now, supply affects not only the price, it also affects the price sensitivity to dividend shocks. And for an asset that is in kind of, or rather, as supply declines, let's say, as supply declines, price goes up, but also price sensitivity goes up. So, which means price volatility is going to go up. So now, what is the logic for that? Okay, so essentially what it says that, let's say there is some good news for a particular firm, for stock N, then expected future dividends rise. So but not only rise, but also they become riskier. So because they're higher, they're also kind of, in absolute terms, movements can become bigger. Now, if the supply is positive, if the experts are holding a long position, the increase in risk makes them more willing to sell the stock to reduce their risk, and therefore the stock price increases less than when the supply is zero. So, which means lower price sensitivity. If, on the other hand, supply is negative, the experts are holding a short position. Now, if the risk goes up, they become more willing to buy the stock to reduce their risk, and the stock price increases bigger than if the supply is zero. So essentially what this says is that kind of lower supply, more sensitivity to shocks. more volatility. Okay, now, and this is a big difference with kind of these standard kind of Cara normal models that are used quite a lot in both finance and macroeconomics. Okay, now, so that's the model. And okay, from then on, what we do is I would show you a lot of the results through essentially all of the results through a numerical example, a calibrated example, which I will calibrate based on, okay, so essentially on the growth of passive management. So I will look at actually two cases, two extreme cases, two polar cases. One is where the passive flows are due to entry into the stock market. And I will assume that passive assets are at 10% of total assets in the baseline case. And then they rise sixfold passive assets. And either active assets stay the same, or passive assets kind of rise at the expense of active assets. So I will look at these extreme two polar cases. And I will calibrate the size distribution of firms based on the observed distribution in the US stock market. So as Gabex and others have found, this distribution of firms and of many other things in the world follow power laws. And in the stock market, and for firm sizes, it is the exponent 1, which means what means kind of intuitively, it means that, let's say, if we look at, let's say we take the 10 largest firms, the average capitalization is about 1 trillion per firm. Like these are the Amazons, the Googles, etc. And if we go to let's say, if we multiply this by 5, we go to the next 50 firms, then the average capitalization is about divided by 5 of each firm. And this is what we see in the data is about 200 billion. So we're also going to assume in the model it's exactly divided by 5 in this calibration. We multiply by 5, we go to the next 250 firms. Capitalization is divided again by 5 approximately. So this is the power law, and actually it holds quite well. So we're going to assume take this as a given. So have this also in mind for what as an indication of what we mean by large firms here. Okay, so we calibrate a few more parameters, and so I will show you now some results from this numerical example. So first of all, these are some return moments. These are not the main results, but just to show you that essentially the model gives return moments that are consistent with kind of the data. So these are small firms. Okay, by design, we have this chosen the calibration so that small firms have higher kappa beta. They have a higher loading of the systematic factor. And the difference between the beta of small firms, which is about 1.35, and the beta of the largest firms. So we have these 5 different groups of firms. These are the highest group. These are the smallest group. So it's about what is more or less what is in the data. So about 0.4 difference between the beta of the smallest and the beta of the largest. Because of the difference in beta, the smallest firms have the highest expected returns than large firms. They are riskier. They also have higher volatility. Okay, so these are the main numbers that I want to emphasize. And now, let's see now what happens when there is a growth in passive investing. What's going to happen to the price of these firms? As I announced earlier, I would look at two polar cases. One polar case is when the growth in passive investing is just entering to the stock market and by new investors. And the other polar case is when there is a switch from active to passive. There's no entry of new investors, just people who are holding their funds in active now decide to go passive, let's say to save on their fees. So and then within each case, I will look at 2 subcases. First of all, where the index includes all firms, the index that these passive funds track, these non-expert investors are holding, or the index includes only size groups 3 to 5, the medium and the biggest, the medium size firms and the biggest firms. They don't include the smallest firms. So when there is entry, so you can see that the price of foreign firms go up, but of the largest firms, they go up the most for both kind of cases about index composition. In fact, the effect is J-shaped. So the price of smallest firms go up, and they go up because of this CAPM effect, this basic CAPM effect that I described earlier, that these firms have higher CAPM beta, so therefore market risk premium drops, causes their prices to go up. But of the largest firms, so for medium firms, they go up the least, but of the largest firms, they go up the most. And this is the intuition that I was describing earlier about the repricing of the idiosyncratic risk of large firms. The effect is more pronounced when the index includes only the medium size groups 3 to 5. And even actually, the within index effect is more pronounced. The size group 5 goes up more than the size group, even more than the size group 3 when the index is a narrower index. Let's now look at the case where the flows are just a switch from active to passive. Now, if the index includes all stocks, there will be no effect. This is kind of a standard CAPM world. This is the only case where there is no effect. If the index, however, includes size groups, only size groups 3 to 5, the medium and the biggest firms, okay, not surprisingly, the smaller firms are going to lose, are going to go down. The biggest firms are going to go up. What is surprising is that the effect is asymmetric. The largest firms are going to go up the most. So not the most, are going to go up much more than what small firms go down. So essentially, the aggregate market is going to rise. So switch from active to passive causes the aggregate market to go up. Okay. Now, return volatility of the largest firms also goes up the most. So here I show you the change in return volatility, the increase in return volatility, which is the biggest for the largest firms in all kind of scenario, except the scenario where there's no change. Now, another table is when, so now let's say that we assume that there are some noise traders, some mispricing in the market. So far, there were no noise traders, no mispricing. We're in a kind of very conventional kind of CAPM world. Now let's say that there are some noise traders, and some firms have low noise trader demand, they have no noise traders, and some firms have high noise trader demand, which in the calibration is that noise traders demand 40% of their shares. So, not surprisingly, firms that are in higher demand by noise traders are going to be more expensive, so they will have lower expected returns. This will matter just for the largest firms, because for the smallest firms, these things are not really going to matter because their idiosyncratic risk is not priced. Only their CAPM beta only matters. And in fact, these high noise trader firms are going to have also higher volatility, just because these idiosyncratic movements are larger. Okay, now what happens if there is a growth in passive? So far, I'm just showing you kind of their return moments, but what happens if there is a growth in passive? So again, the effect is going to be bigger for the largest firms. So this is kind of this effect that we already saw before, that the kind of passive tends to cause the price of the largest firms to rise the most. And moreover, if you compare, let's say within the largest group, the increase in the change in the price of the overvalued firms versus the undervalued firms, the overvalued firms go up more than the undervalued firms in response to a rise in passive investing, especially if the index includes only kind of is a narrow index, and especially if there is, as you can see here, if there is this switch from active to passive. Actually, here there is a very big difference. The large overvalued firms go up hugely. So, and I will explain to you the intuition for that. I already kind of described it a little bit earlier, but so we see the J shape. We see that the effect is bigger for the overvalued firms. We see that there is the asymmetry in the kind of the prices of the losing firms go down much less than the prices of the winning firms go up. So passive investing causes the aggregate market to go up. And why this effect is so large is because of this amplification that I described. In this case, the overvalued investors hold short positions in overvalued firms. The experts, they hold short positions, and this increase in passive triggers this amplification chain that I described, causes these firms to be more volatile, investors to reduce their short positions, causing kind of even more, these firms to go up even more, causing even more volatility, etc. Okay, so so a final result from this my little example is that this index, okay, so here I do a different experiment. I say, let's suppose that we add a stock into the index. So just one stock, there's not just a growth in passive. So passive is what it is, how many passive funds there are. But let's say that for some reason, the Standard & Poor's changes its definition of the index and decides to include a particular firm into the index and takes out another firm of the same size group. What happens? So, okay, so the firm that is included goes up as the index effect literature has shown empirically, but how much it goes up depends on the size of the firm and also depends on whether it's an overvalued or undervalued firm. So the biggest firms benefit the most from being included in the index. So here's the percentage price change. It's biggest for the biggest firms. Then if a small firm is added to the index, it makes essentially no difference to each price. If a big firm is added to the index, it makes a big difference. And this doesn't, no matter how the index is constructed. So, and also its return volatility goes up the most as well. Okay, so these are all the results from the calibrated example. Now, what I want to show you is a little bit of evidence, kind of showing, kind of supporting these mechanisms, that all these theoretical mechanisms that I described. So we look at flows into these S&P 500 index funds and ETFs. And okay, so, and over the period 96 to 2020, during which period there has been this big rise in passive investing that I showed in my first slide. Okay, so frequency is quarterly. So here what we do is that we regress contemporaneously the return of large firms, of the top decile of large S&P 500 firms, so the 50 largest US firms, I mean, or as firms in the 50 largest firms in the S&P 500 index, minus the return of the index itself. And we see how this depends on passive, on the flows into passive in that quarter. So during quarters where flows into passive are unusually large, let's say are larger by 1 standard deviation, then these large firms do better than the index. They do 0.55% better than the index, which is about 1/3 of standard deviations of the difference in their of that return, of the relative return. Now, if we and this still holds, is statistically significant and still holds even if we control for a bunch of things such as the return of the index itself or the volatility in the market, etc. Now, if we extrapolate, if we kind of do a calculation of what this implies for the cumulative effect, we find that the rise in passive investing over the past 25 years caused the prices of the 50 largest US firms to rise by 30% more than the US stock market. So essentially, which is a big kind of benefit for the largest firms. Kind of, in principle, it reduces their cost of capital, makes it much easier for them to issue shares more cheaply than the remaining firms. So, okay, we can do a similar test for what happens to volatility, and we can show that we find that the volatility of largest firms rises more than the volatility of smaller firms or of the remaining firms in the S&P 500 index, following unusually high flows into passive funds. So not only flows into passive funds cause the price of the largest firms to rise the most, it also causes these firms to become more volatile, kind of this inverse kind of connection between risk and return. We would expect that if when volatility goes up, price goes up less because these firms become riskier. Okay, then, and finally, we can also look at how the effect of index additions depend on size. So we know, of course, as I already said, that when a firm is added to the index, its price goes up. And empirical studies have divided this effect into the effect from the announcement that the firm is going to be added in the index until the day before the firm is added to the index. This is the first column here, from the announcement to the effective date -1, 1 day before the effective date. And then there's also a return that is computed before the effective date, 1 day before the effective date, and the effective date when the stock is actually added to the index, and then the subsequent return. So the literature has already shown that there is a premium, a benefit for these firms when they from the announcement to the effective -1 and from the effective -1 to the effective. What we show is that this effect depends on size. It's bigger for bigger firms. It's much bigger for bigger firms. And here's the graph that I promised earlier. This is what happened when Tesla was added into the S&P 500. Tesla was added to the S&P 500 when it was quite big, unusually when it was quite big. Kind of most stocks are not added to the index when they are so kind of when they are added kind of at the earlier stage when they are not as large. So but for Tesla it took time because it didn't have positive earnings. So S&P 500 had some criteria to add firms, and Tesla had to meet this criteria. Even though it was already quite large, it was not meeting some of the criteria, so it took some time for that. So you see that at the time of the announcement, Tesla's market capitalization was about 400 billion. By the time the Tesla was added to the index, this had risen to 600 billion. So Tesla added 200 billion to its market capitalization by being added to the index, which is a huge additional return, and is consistent with our theory and also obviously with the data that I showed you. So, all right. So now let me recap and conclude. Okay, so I showed you kind of essentially two main themes. I described two main themes. One is that, first of all, that I mean, both of these themes stem from the growth of asset management. So one is that agency problems in asset management give rise to procyclical trading, and which has implications for volatility, systemic risk, etc. And the other is that passive investing is not neutral, but benefits primarily the largest firms in the economy. Now, within these kind of ideas, there are some common elements. So in both cases, I talked about an inverted risk-return relationship. That in the first case, I said that overvalued firms tend generally to be more volatile when I was describing this procyclical trading, that this procyclicality applies mainly to overvalued firms and causes their higher volatility. In the case of passive investing, I said that these largest firms become not only they go up the most, but also they become the most volatile. And the other common element is this theme that kind of there is this push towards market overvaluation. We may sometimes be concerned about kind of markets crashing, but we're not as concerned about markets going up too much. And there is a bit of that happening as a consequence of this asset management. So now, what are the implications for policy and for practice? In principle, there are many implications. And I think this is where some of the work in that area now is happening, and where I think more work is happening, because regulators and policymakers would need some guidance, are asking for some guidance, need some guidance for that, and are asking for it. Is first of all, based on what I showed you, should we rethink about redesigning the way asset managers are being evaluated, and even the contracts they are having, in light of the incentives that these contracts and the valuation metrics generate? For example, as I showed earlier, these constraints that they should not deviate much from indices generate procyclicality. So should we really constrain so much managers not to deviate from indices, or maybe should we evaluate this? Should we evaluate these constraints based on a longer horizon, as opposed to a kind of over a short periods of time, kind of how we measure risk? Maybe we should measure these deviations over a longer horizon. Should we maybe evaluate these managers, create some metrics that characterize how much kind of this kind of procyclical trading takes place just to meet these constraints happens, and maybe kind of try to steer managers towards not trading so much procyclically. Okay, so that's one set of issues, which one set of normative issues. The other set is we should maybe think also about the design of the indices. in light, so I showed you that indices are not neutral. Even if when you design an index that holds all firms and is market capitalization weighted, the effects of following that index can kind of be biased in favor of the largest firms in the economy. So should we maybe we design indices that may have more balanced effects, perhaps, in market prices? For example, in sovereign bond markets, indices often have limits on weights, caps on weights. Should something like that be considered for stocks? So anyway, but in order to answer these questions, these normative questions, it's important, first of all, to have an understanding of what the current arrangements are generating. And this is what I try to emphasize in my talk. So let me stop here.
All right, do we have any questions? Anybody at the head table have a question?
This is Jim Chen, Michigan State University. Very powerful talk. I want to make sure that this is understood by everyone in this room. I take from your presentation that flows in the rise of passive investment, especially as both retail and institutional investors flee active for passive investment, would explain all of the existing known anomalies from purely rational pricing. All right, and to be specific, you now have a mechanism for explaining momentum, the value effect, the size effect, and the one that you did not explicitly address, although it's implied in all this, is liquidity. So is that an accurate description of your hypothesis and your work? And I guess as a second question, am I right about what I've just inferred about the impact of these flows on liquidity, because that directly is related to supply and demand for these stocks?
Okay. First of all, I may need to come back to you on the liquidity issue. On the first thing that you said, yes, we can speak to a number of these anomalies. So I think that the story behind momentum and value is flows play a big part of it. I think this is a flow-based explanation is a good part of the story. And this flow-based explanation, somehow these flows that are chasing performance is a natural kind of foundation for that. I mean, so I think that flows chasing performance is really kind of an important driver of momentum and value. And there's actually one of the papers that I mentioned by Dong Lu, my colleague Dong Lu, actually tests exactly that connection between momentum and these performance chasing flows, and find that performance chasing flows explain a big chunk of momentum, especially for large firms, and especially over the recent period where there is kind of this growth of institutional investing. So you did not mention one anomaly, which I wanted to emphasize as well, which is this it's called the beta anomaly or the volatility anomaly sometimes, which is essentially that there is not the relationship between risk and return is not as strong as implied by standard finance models. Sometimes it's even non-existent, and sometimes can even be inverted. So this is something that I talked, and I believe that also this, what I showed you, kind of can speak to that inverted relationship. And the size effect is, effectively, I mean, in some sense you're right. At least I had not really drawn this connection in my talk, but you're right to say that if there's this switch to passive, this is going to push very high up the large firms, which could reduce their expected returns. So, and the size effect is really that, is that the small firms have higher expected returns than large firms, kind of puzzlingly higher expected returns. So this could, the growth of passive can be a driver of that. Now, I may have to come back to you on this liquidity. Would you mind kind of repeating your question about liquidity? I didn't understand that bit?
Sure. Let me ask that question and also make the observation. I want to be absolutely clear when you say the inversion of the risk-return relationship, right, which has always been described as the first law of finance. With greater risk comes greater return. But this is completely contradicted by what you've pointed out, which is confirmation of the low volatility anomaly, right, as documented by people like Baker and Wergler. But let me talk about the liquidity and explain what I mean by that. So much has been made of the so-called Ivy League portfolio concept, right? That you have assets that are deliberately illiquid. Real estate, commodities, okay, swaps that are based on these assets. If this is generalized to publicly traded asset markets, and to hear your presentation and your argument about asset flows and the demand for passively indexed, non-active managed funds by institutions and by retail investors, I think the logic flows something like this. Less liquid assets are going to be affected because there's greater demand, right, for the most liquid assets of them all, which are the largest, most highly capitalized firms. Okay, so there's just less information, less demand, and without going through the constant versus the idiosyncratic versus the systemic components of pricing, right? Just informally, it occurs to me that what you are saying is confirmation of that additional factor, right? Much of financial literature of the last 30 or 40 years, contemporaneous with this rise in the shift from active to indexed or passive investment, says that there's a zoo of factors: the small firm effect, the value effect, the momentum effect, and arguably the liquidity effect, which I would include in that zoo. So that's what I mean by liquidity, and why I think your work validates what has been called the liquidity effect in much of the financial literature.
Okay, yeah, thank you very much for clarifying. Now I got it now. Yes, and indeed, what essentially, I agree with you. Essentially, you are saying that if kind of the rise in passive kind of coincides with the kind of the concentration of investment of these flows kind of towards the more liquid segment of the biggest segment of the market, yes, there will be a set of assets that are going to be losing, are going to become kind of cheaper, and yes, and then we can kind of see this premium kind of associate this kind of discount for assets that are kind of smaller and more illiquid. And this is very much in line also with these tables that I showed with this, that when the index is a narrow index, that it includes only the medium and biggest firms, then the smaller firms are going to be losing, of course. Yeah, very much agree.
Thank you.
Do we have any other questions? Yes, we have one in the front here.
Oh, thank you very much. This is Rita De Clesia from Sapienza University. Thank you for the interesting talk. I have a technical question on the model. You are assuming that both of the idiosyncratic and the systemic component that can be described by the same dynamic, some kind of square root mean reverting. Have you just thought or assuming a different, I have some just doubt that they might be modeled by the same dynamic. Is this going to have an implication? I don't know if you have thought about it. Thank you so much.
Yes. So let me just clarify one thing: is that we are assuming the same kind of form of the stochastic process that they are following, but we allow the parameters to be different. So essentially, okay, what we so the general model that I showed you is for any kind of arbitrary parameters to these processes, and the parameters for the system, for this common systematic kind of factor can be anything and be different than for the idiosyncratic factor, and can be different across all the firms. In the calibrated example, what we're assuming is that the systematic factor process has the same kind of, is a scaled version of the idiosyncratic process. So it has the distribution has the same form, same general form, but again, it doesn't have to be identical. It can be the case that systematic component is bigger than the idiosyncratic component, or so it just has to have has to be a similar has to have a similar shape. So yeah, but no, I don't think that it really matters for the mechanisms now. Why do we do the other? Maybe another thing that I can say about your question is, why do we do square root processes? It's just because with this model we can solve it in analytically, while, for example, another possibility would have been to use something that is quite used in finance, which is this geometric Brownian motion, but which also has the property that the volatility of changes in absolute terms increases, volatility of dividend changes increases with the dividend level. But this is it's not possible to get these closed form solutions. This is why we went for the square root. So let me just leave it at that.
Anybody else? No? All right. Well, yes, we got one. All right, go ahead.
Perhaps this is beyond the scope of the paper, but just some general discussion, or if you can shed light on the applicability in the developing and emerging and developing economies about this model, and or just general discussion and the link between this asset price volatility with the inflation. Now everybody is worried about the controlling inflation both in developed and developing countries, but those are just general indications. Since you are an expert, you can shed light on that. Thank you.
Absolutely. I think that these are very important issues, and so I mentioned briefly that this procyclical trading policymakers are concerned about this because it can. One reason is because of the effect that it can have on the financing costs of emerging economies, so that sometimes these emerging market bond funds, they experience outflows following poor performance, and emerging economies have a very hard time refinancing their debt because interest rates skyrocket. So yeah, so I think that essentially these ideas and can help. Maybe ideally one could integrate them into richer macroeconomic models, where we can maybe think about I don't know how, let's say, shocks to U.S. monetary policy can affect emerging markets, not only through let's say the standard, let's say channel of let's say UIP, uncovered interest parity, but also through flows that funds can experience, which let's say if interest rates, just to be more specific, if interest rates, let's say in the US go up, then this can cause I don't know outflows from bond funds investing in in emerging economies. And this can be an additional mechanism that can, I don't know, push down the long-term yields of, that can push up long-term yields of emerging markets. So it's not just the essentially fund flows, the fund flows and the procyclicality that I described could matter also for these macroeconomic transmission mechanisms. Actually, we do have some work. Let me just one more thing. We do have some work actually on that with a colleague of mine at the LSE, Walker Ray, and Pierre-Olivier Gourenchat, the chief economist of the IMF, on precisely this topic, how monetary policy is transmitted partially through this demand by changes in demand shocks by investors. So I hopefully will integrate even more these ideas.
Just a quick one. This is Fazli Siddiq from the University of New Brunswick. What's the main takeaway for both institutional and non-institutional investors, given the volatility that we are experiencing and will continue to experience not just in the economic realm, but also the international tensions and so forth. Is there something that you might be able to shed light on, given the experiences of the last couple of years and the uncertainty of the future?
Okay, that's a difficult question, and one I would ideally I would have to think a bit more to say. But let me try to keep it a little bit narrow and kind of close to the things that I said. So. Well, look, I will talk a little bit about what we saw in the UK over in the past week that I presume many of you are familiar with, that we saw this kind of massive fire sales of government bonds by pension funds because of the exposures that they had this kind of exposures that they had to come up with liquid assets to pay for some exposures that they had to supposedly hedge interest rate risk. And because of that, they were selling bonds, which caused bond prices to go down even more and caused them to have to generate even more cash to cover positions. So, well, I think the main thing the lessons from that and from things that I said in my talk is that we have to think about the roots of the procyclicalities. So in the case of the pension funds, okay, so the way they were implementing this liability-driven investing, I mean, this hedging, they were hedging their liabilities. It looked kind of okay in theory, but in practice it was not okay because their assets and their assets were not quite the same thing as their liabilities. Their liabilities were the pensions. The assets were not bonds, but were these kind of derivatives that were supposed to be like bonds, but they required different payments, kind of at different horizons. In the context of what I said, some of these procyclicalities are driven by this, for example, these tracking error constraints. So I think that one has to maybe, I don't know, has to allow maybe for greater flexibility for example, the way the funds are managed or the way the managers are compensated to reduce this procyclical trading. So I guess this is where I would look. I would look at kind of at the mechanisms that cause the procyclicality and how to limit those. Let me maybe say this for now. I mean, I think your question is very good. It's a bit open-ended, and I would have to, I don't know, one has to think kind of more carefully based to give more complete answers. But at least I give you a bit of a start for answer.
Well, thank you, Dimitri, for such an insightful talk. I think everyone really enjoyed it. And we have a little presentation we'd like to make. Gentleman in the back, if you could advance the slides for us. All the way to the end. There we go. Can you blow that up now? Share the screen. So we just want to say thank you to you, Dimitri, for this past year as president. So we have a picture here of the plaque that's going to be coming your way, but it has the gavel on it that you can take off so you can officially call meetings to order or call them to an end. But anyway, we just wanted to say thank you once again.
Well, thank you so much. I mean, it was an honor for me to be involved with this, the International Atlantic Economic Association. Thank you so much.
All right, thank you. And I guess everyone now, we're at break for lunch. So sessions will start back up around 2:30, right in there. So depending on what you're involved in. Thank you for staying.